Hi, and welcome to our second quarter portfolio and economic update. My name is Sally Sauvignon, and I'm the Director of Client Services and Marketing. Here with me today are Bruce Frankel, Andy Zattel, Marilyn Suey, and Mark Machado. I'd like to review YBFP's mission statement. It's our mission to guide and empower our select clientele to make informed decisions regarding their wealth so that they may make an even greater impact on the people and causes that they care about deeply. Yerba Buena Financial Partners follows a proprietary process called the Wealth Impact Process, a disciplined approach that we've created to provide our clients with personalized service of the highest caliber. With that, I'd like to turn it over to Bruce.
Great. Thank you, Sally, and thank you, everyone, for attending today. And Mark, it's great to have you here as our guest speaker. For those of you who have attended our previous quarterly webinars, you know we like to look back in the past quarter to update on what was going on and what we're seeing here today, and then what we're seeing going forward from the end of the first quarter. Most of the statistics that you will see here up on the screen and hear us talk about are mostly through the end of the first quarter. We do have to submit this to our compliance department a couple weeks before the event and get this approved through our compliance department. We have updated some of the statistics from the end of the first quarter, and we will point those out as well along the way as we go through it all. Let's start with what was going on the first quarter as it pertains to volatility. Gold is a good measure of that as well. And Andy, I know you've been following this. Please, what are your thoughts of what you're seeing there?
Yeah, thanks, Bruce. I think in the first quarter, the S&P was basically flat. It had a 1% return. Treasury bond yield dropped to 1.9, but has come back to 2.2 and change to where it started the year. The emerging markets has done well. For the first quarter, just under 2%, but has had a remarkable run in the last 6 weeks to come back at over 8%, 8.3%, and gold was basically flat in terms of what it was, its performance for the year. Well, let's take a look at what the U.S. has done relative to other international situations or indices. I mean, again, the S&P through the end of the first quarter was up 1%, Japan was up 10%. The euro was up 16. And in Europe, I think that the gains were mainly driven by the aggressive easing of the European Central Bank. A weak euro and lower oil prices. And it's funny how the lower oil prices there create gains there, while lower oil prices in the United States create uncertainty and pullbacks in other areas. The gains, though, haven't been a straight line at all, as you can see here. I mean, for the S&P, for example, was down 3% in January. It was up 5.7% in February, and then down again in March by 1.6, and up just under a point in April. So it's never a straight line, as much as people like to think that returns are a straight line. And we're going to be talking a little more about volatility and the volatility index a few slides down the line. So.
Right, but suffice it to say, it's been pretty volatile. Every time a piece of news comes out, we're getting knee-jerk reactions, and when you look at this line here, I mean, it has been pretty volatile, right? But like you said, we'll talk more about that in a few minutes. As we look at the different components of the economies and the major economies around the world, and we're looking at unemployment and GDP growth and inflation. Again, Europe had a big jump when it comes to their GDP growth versus us, and it's kind of sad to say. I mean, they only had 1.3% GDP. The U.S., we'll get into expectation setting towards the end of the webinar here, but as it turns out, the U.S. only had a 0.2% GDP growth in the first quarter. Nothing to write home about.
That's anemic.
And the expectations are once the adjustments come in and the revisions come in, that we may find that it was actually a negative quarter. So we kind of have to brace ourselves for that when we talk about what we're thinking about going forward. You can see unemployment in the euro area is still just not good, and especially in the southern areas around the Mediterranean in Europe, inflation is just very, very high still, especially for younger folks, the people in the 25 to 35 age category. Not on this chart is China, and for that I'd like to turn to Marilyn, who I know has been studying China and what's been going on over there. But Marilyn, what did you see in the first quarter?
Thanks, Bruce. Well, China's first quarter growth is the slowest that we've seen in 6 years, down to 7% from 7.3 in the fourth quarter. And for many, many years, 30-plus years, China has had an incredible growth rate of more than 10% on average. So the slowdown, the comment I would make is that the developing markets, as Bruce just said, we would love to have 6.3% plus GDP. The forecast going forward is that the International Monetary Fund says that China's growth will slow down even more to just a little over 6%. And its slowdown will more than likely affect emerging markets more so than the developed markets just due to trade relationships.
And these are the numbers that China is actually making public and putting out, right? I mean, we always talk about that we can't trust, have big faith in what they're putting out. Obviously, they're a controlled system, and they put out to the public what they want to put out to the public. There's been other indicators that are making it look even worse than this. Their exports have not been good, and their currency is fluctuating more. And, right?
Debt issue.
Yeah. Well, the debt issue, I think we're going to talk about.
Right.
Right. Okay. As we move forward in talking about the first quarter and the different market indexes around the world, again, as Andy talked about just a bit earlier, we see where Europe has done pretty well. So the anticipation of their quantitative easing hitting the economy, right, that anticipation translated into their markets doing better than the U.S. markets, of course, but also in general around the world in the emerging markets.
The update to those numbers, by the way, this was through March 31,
right.
Through yesterday. Again, the S&P was up 2.7. The world index was up to 4.65, so that's pretty significant. Emerging markets was up to 8.34 for the year-to-date return, and Europe was up to 7.69.
Right, so there's some jumps.
Tremendous growth in 6 weeks.
Yeah. I think Germany has come out, and their growth has been a bit suppressed now in April, so.
There's the first increase in their bond yield option, I believe.
Yeah, their bond market we're going to talk about in a little bit as well. It's been a bit heretic, let's just say. Commodities, as everyone knows, commodities have been fluctuating a lot. Needless to say, in the last 12 months. Commodities across the board, by the way. We're most familiar with what's been going on with oil. And you can see here the commodity index still went down quite a bit in the first quarter, and we saw other things do quite a bit better. The REIT market, real estate investment trusts, have been very good, and our clients have benefited from the use of some of those REITs. We have to talk about the Fed and monetary policy and the Federal Reserve. We have entered what a lot of us like to call silly season, and that is that the good news is bad news and bad news is good news as we anticipate what is the Fed going to do. And we get into this period of time of Fed guessing and prognosticating about what the Fed is going to do with interest rates and when they're going to do it. As we know, they have stopped quantitative easing. They telegraphed that pretty well. But the volatility that's going on in the markets, as well as the unemployment reports, are making it so the guesswork about the Federal Reserve and what they're going to do and when they're going to do it and by how much they're going to do it has not been fun to watch. You know, when we get good news about earnings reports or good news about some sort of economic indicator, then the market goes down 200-300 points on the Dow because the market participants are anticipating that the Fed is going to raise interest rates, which is going to slow down the economy, and vice versa. Andy, you wanted to?
Yeah, I mean, you and I have been talking about this for a couple of weeks, and you alluded to it in one of your blog postings most recently about the unconventional policy of the Fed.
Right.
And whether it really is a one-time shot or it's part of the new normal to try and, better control what's going on. I mean, the old expression is don't fight the Fed, right? And they're going to do what they want and they're behemoths. But any thought at all about whether, how you think the Fed will continue to be creative?
Right.
This was a one-shot.
Well, I mean, that's a great question. In the end, no one knows what they're going to do, right? But what has happened now is this has become more normalized behavior. Central banks around the world are doing the same thing, so they're following the Fed's footsteps and saying, okay, well, if they can do quantitative easing over and over and over again in the U.S., well, hey, that's a pretty good idea. Why don't we do it here? So Japan is doing it to the nth degree, and Europe is now doing it, and they're getting some benefit from it because they're starting to see some inflation that they want, not too much inflation. The challenge here now is the Federal Reserve of the U.S., I'm getting ahead of myself a little bit, but the Federal Reserve of the U.S. now has a $4 trillion balance sheet and no plans, not any public plans of how they intend to get rid of that. And we're seeing some of the impacts in the bond market now of all of this because there's a lack of liquidity in the bond markets. The U.S. Federal Reserve owns more than 30% of the outstanding debt, right? That makes bond market to be illiquid. This past week, we saw unbelievable swings in yields and interest rates around the world. And a lot of people think that's in large part due to lack of liquidity. I think that, I mean, let's look at it this way, Andy, in answering your question. The Federal Reserve said that they were going to start raising interest rates when the unemployment rate went to 6.5%. That came and that went, and they didn't do it. Then they said they would raise interest rates when we're at full employment and inflation is at 2%. So the rules of the game seem to keep changing. So to be able to say what we think they're going to do and when they're going to do it, I mean, it's anybody's guess.
Right. I think it makes it even more challenging for what we do because being able to base decisions on historical data and patterns when the rules change make it a much more.
Well, and it leads to the next thing that I was going to turn it over to you about is to talk about volatility, right? It's creating. I'm sorry. So yes, the geopolitical environment. I'm getting ahead of myself. Forgive me. All right. So yes, the geopolitical environment around the world is a big impact on the economy and the markets. ISIS is still rearing its ugly head. They are just horrible people. Let's just put it that way. The measles outbreak in the U.S. scared a lot of people. The big excuses, as I will call it, about the tepid GDP growth in the first quarter were the weather conditions in the East Coast, and it's funny how that seems to happen every winter. I don't understand how we get into that. I was in
Philadelphia and it snowed last month.
Yeah.
But just this past Sunday, there's a baseball game at Coors Field, right?
Right. And
6 inches of snow on Sunday morning, but Major League Baseball could get it together to clear the snow and play the game. So you wonder why the rest of the industry can't.
So the three big excuses were weather, and that seems to be an annual excuse about poor GDP in the first quarter every year. The port strike that we had out here in the West Coast, which does hold up a lot of inventory and does have huge potential to impact things, as well as the dollar. The dollar has strengthened more and more and more, which makes our goods more expensive and is going to impact exports. And it definitely did that. These seem to be more and more excuses because now, as retail numbers come in now, about April, and just the last few days, they're not good. And we've been told by the economists and the prognosticators that lower gas prices will lead to greater consumer spending. We've been told that once the winter chill ends, that will portend for greater consumer spending. and we're not seeing it. Now, I have to say one area that we are seeing it is in amusement parks, right? Amusement parks. I was in Disney not too long ago with my family, and it was during a school week, and Disney was packed. The lines were long. We'll see how the second quarter numbers come out, but the first quarter excuses seem to be becoming a regular pattern. So now, yes, let's get back to volatility again, and as we see on the screen, the volatility index going back quite a bit.
Right, so this volatility index is really a measure of investor sentiment looking forward over the next 30 days. And you can see here that it kind of spiked. It was pretty level for most of 2014. It spiked at the end of 2014 and then again at the beginning of January, and has come down some since. But in speaking about volatility, the other side of volatility is not just this sentiment, but actually what's going on. And it's very funny. Some people define volatility as that sudden surprise when they open their account statement and they see their account has declined in some significant fashion. And forget that when they open the statement again 30 or 60 days later, that maybe there was that same upward movement for their account. So volatility works on both sides. We just always seem to focus on it when it's going down. But there's also intraday volatility. And I just finished reading Michael Lewis's new book, Flash Boys, which is be a topic for another discussion on another day in terms of what that does. But his research in that book says that the U.S. markets between 2010 and 2013 was nearly 40% higher in terms of volatility than between 2004 and 2006.
Yeah.
That's a significant amount of activity and volatility. And he attributes it perhaps to a combination of high-frequency trading, right, as a result of the Reg NMS, which has a long history with us, but also that volatility affects computer-based trading algorithms. So it almost just exacerbates itself and feeds on itself. And they're trying to work to fix it, but those, how, those big computers.
The machines are going to run the market.
The IBM Watson, right?
Right.
But one of the things, though, there's a quote, though, from Warren Buffett I wrote in 2008 in the op-ed in New York when he was talking about volatility and these declines. And I think what he said was, bad news can be an investor's best friend because it can let you buy a slice of America's future at a marked down price. That's Warren Buffett.
Wow. All right. Good. Let's take a little intermission here for Sally. I know there were a couple things you wanted to remind people about, Sally.
Yes, I have a few updates. Thank you. Hear comments from our advisors on the weekly market commentary in Mint Edition, read news and watch new videos regarding YBFP, personal finances, investments, entrepreneurial, and wealth planning topics. Follow us today on Facebook and LinkedIn. Also, we just added a blog to our website, ybfp.com, where you can hear frank comments of Managing Partner Bruce Frankel on topics geared toward accredited investors and entrepreneurs. Read topics such as economic forecasting risks your hard-earned, hard-saved wealth, and the silicone-injected stock market bubble, when will it burst? To subscribe to the blog, visit our website and click blog. Enter your name and email under the Receive Future Blog Posts. And last, please don't forget to schedule your annual reviews for 2015 today. Email or call our office.
Great. Thanks, Sally. Yeah, I'm a blogger. Who never thought? All right. So everything we just talked about, what does this mean for what we've been doing around here and our models? And again, I know it's repetition for people who've been attending our webinars, but for the newer folks, we do this by looking at our most highly populated model in the practice here, which is a moderate model of 60% equity investments and 40% fixed income investments. That's made up of ETFs and mutual funds. ETFs are exchange-traded funds. The green will show you how much we have in cash. The red shows how much we're in the fixed income components, and the blue show you how much we're in the equity components. At the end of 2014, you can see that we had no fixed income investments. Interest rates were going up at that time. There was a lot of volatility in the bond market, and we were out. So we had a 50-50 mix there of cash to equity. That pretty well stayed true in January. You can see we entered some fixed income positions in February. Those were mainly in emerging markets as well as in
Inflationary hedge.
Inflation hedging, yeah, thank you.
Floating rate and treasury inflation protected security.
Correct. That reduced a little bit in March and has held pretty well true to date. This now shows you the makeup of that model, and you can see it's a very, very well diversified model. Again, the blue are the equity positions, the red are fixed income, and the green is cash. And if you scan across, you can see that a lot of the sectors that we have exited are in relation to the commodity market, materials, the energy space. You know, we've seen a big reduction in the productivity in the energy sector. So we have left a lot of those positions and have stayed in others.
Do you want to do the disclosure in that radio voice, Bruce? Because we have to deliver those last two lines there.
Oh, so compliance wants me to say, well, international investing involves special risks such as currency fluctuation, political instability. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, and bonds are subject to availability and change in price, as though our highly educated listeners didn't know any of that. Forgive me. All right, let's see where we are today. We'll go through and talk about the economy. We've already touched on some of these things, so we'll be able to go through quickly and talk about monetary easing, what's going on in Europe, and bond yields, and then talking about the rate hike. One of the things that I like to talk about quite a bit is what's going on in the employment and unemployment arena. And as you can see on the screen, the lower line there, the dark line, is looking at the published unemployment rate as put out by the Department of Labor of the United States. So we can see that we've had some fluctuations. Obviously, unemployment went up dramatically in 08, 09, and then we start to see a nice steady decline there, which is wonderful. We here feel that number has a lot of, I'll just say, noise in it, and we prefer to look at a couple of other numbers. So the white line is showing you the labor participation rate. Of the folks who are ready, willing, and able to work, what percentage of them are working? And that's the right-hand scale on this graph. And as you can see, the red line is drawing it back to where we were in history based on the level we are at today. And that is 1979. So our labor participation rate is just not coming back like we would like to see it. Even more telling is this graph here. And this graph here represents what the Labor Department calls the U6 number. The U6 number points to those people who are also marginally employed, marginally attached workers, they call it. And these are people who are working part-time and want to be working full-time, as well as people who have accepted a lower-paying job that would rather be in, because they just needed to get to work, rather than what they are used to or educated in being. And as we can see, that number is quite a bit higher. Now, that uses the left scale, and that number is hovering right around 10.5%, 11%. This, to us in this office, is a better gauge of what's going on out there in the labor market. And we don't want to be all pessimistic here, because long-term we're not pessimistic. And if you've read recent blog posts and articles, you can tell that. We just had a labor report come out last week on Friday, and the market got very excited about this. So this was one of those where good news was actually good news in the marketplace. So we had over 220 some odd thousand jobs added to the market. And as we peel that back and start to dissect it and take a look at it, in that job report, the full-time jobs that were lost were 252,000. Part-time jobs that were gained were 437,000. So when we look at the published unemployment number, we have to realize that a lot of people are taking jobs because they just need to take jobs. Of those part-time jobs, the vast majority of them were taken by people 55 years and older. So we are seeing that and Andy, you've brought this up in the past about millennials, right?
Yeah, and with the U6 rate, which you were talking about there in this participation, I mean, where do the people, do they fall into this calculation who maybe already reached normal retirement age according to Social Security, or they've decided they're, idle hands do the devil's work, so they want to go back out and do something and be productive. But how do you...
So the U6 rate takes that into account.
Takes into the person who's 67 years old and wants to go back and work in the clothing shop part-time.
If they are ones who are, and this is all done by surveys, right? And the other thing I should point out, these are mid-month to mid-month numbers. They report them at the beginning of the following month. A lot of folks think they're end-of-month to end-of-month numbers. They're really mid-month to mid-month numbers. So there's been a few weeks since, and we'll see what it comes out to.
The millennials you were talking about, though, I think and we were sharing.
They're challenged, yeah.
Yeah, we were talking about that the other day, and I think you shared with us the statistics that the educated millennials are extremely employed. Yeah. The uneducated, not so much.
Right.
And the millennial plus is now getting close to the same weight in population as the baby boomers.
Actually, they just exceeded the baby boomers in the workforce this last month.
Because baby boomers are 10,000 people a day are turning 65.
That's right.
Yeah. A lot of people, Mark just exasperated over here. So, well, okay, so this is all well and good, and one of the big issues that's going on is the fact that we're not getting wage growth in the economy. We hear the administration talk about this all the time, and I'm simply one who believes that until we see the previous slide improve, right, with the participation rate and the U6 rate.
And the quality of the work.
Exactly. And so then we're not going to, that means that, I mean, it's just logical thinking, right? I'm not such a genius here. If we get into a point where we're at genuine full employment, then that means that the job seeker has more leverage in how they're negotiating, and employers are going to have to pay more. That's why we're not seeing any significant wage growth throughout the economy. Now, the Bay Area is a cocoon here. We live in we'll hear Mark talk about this as it relates to real estate as well. I mean, we live in a cocoon here when it comes to this. Now, in Marin County, I've talked to a couple of recruiters, and they simply cannot find enough candidates to fill the positions for the contracts that they have to fill roles in companies here. This is true throughout the Bay Area. You know, Silicon Valley is on fire with technology. A lot of Silicon Valley has actually moved to the city. The city's on fire with that, as well as finance in the city. And Marin is booming like crazy. BioMarin can't build enough buildings over here. They just announced they're going to build a couple more buildings.
And the city does its part as well to increase wage growth by mandating a higher minimum wage.
Yeah. Well, let's turn to real estate now. Real estate is a very important component of how we suggest people invest their hard-earned, hard-saved money, and is a very important asset class and a piece of the economy, obviously. So Mark Machado is with us, as you know, from Bradley Real Estate. And Mark, I'm glad you're here. And I mean, let's talk about it. What are the trends that you're seeing out there nationwide? Let's start there at the bigger picture and bring it home from there.
Well, nationally, you know, most of the country is still trying to catch up with pre-2008. With housing to catch up as far as what their values are.
Right.
Certainly here, it's a whole different story. But yeah, so we're coming back, but it's not quite back yet nationally.
The nationally has its own issues as well, but then let's bring it to the Bay Area, right? How are we doing here with prices?
Well, prices here, as I listen to you guys speak, brings me back to my economics classes, right? Supply and demand, and it's a supply and demand, right? So there's no inventory here. Lawrence Young, the chief economist of the National Association of Realtors, he spoke about 4 to 5 months inventory nationally being tight. And he said 6 to 7 months would be great. Okay, that would be a balanced market. Well, we look at it here as, 4 months would be incredible.
Nice,
right? And so in the Bay Area, we're seeing anything from 2 to 3 months worth of inventory. And I just read an article the other day that said in some towns in Marin County, we've got about 40 days worth of inventory.
Wow.
So things are extremely tight here.
Okay. And that's creating a frenzy, right? When it comes to the market. Tell us about some of the things that you're seeing.
It's really hard on buyers. If you're a seller, it's great. But what we're seeing here are multiple offers, all cash offers. Where's all the cash coming from? You would know.
Right.
But a lot of people have all cash and multiple offers, 10, 11. You experienced something on the street that you live on?
Yeah, in my neighborhood, people in the house next to us put their house on the market. They scheduled an open house. The street went crazy before the open house, before the doors were open to the open house. People parking up and down the street.
Wow.
No, seriously. Up and down the street, people standing in line at the front door, like to break the doors down to get into the house, to be the first people, so they could be the first people to make an offer, I guess, right? And in the end, that really doesn't matter if you're the first people to make the offer,
Cash
right?
matters.
Right, cash matters, right.
When you say, Mark, real estate people, location, right?
Yeah.
So, we have clients in San Francisco who just put a house on the market, 12 days, boom, couple of showings, 30% over asking, an 18-day close.
Yeah, all cash.
Done. We just, on one of our clients, we just helped sell some properties in Arizona, right, for example, and in Monterey, or Carmel Valley, California. And the one in Arizona, these are very unique properties, again, but 20% below what someone was hoping to get or what they thought it would be valued at from when they bought it.
Right.
The Monterey property is still almost a third less of what the decedent thought the thing would be worth when she wrote up her notes. So I guess it is really about the spot. So as San Francisco gets overbid like this, then it moves to Southern Marin and Orinda, and then it just keeps translating out.
Right. It's also, it has a lot to do with what you guys been talking about, and that's jobs.
Right.
There are jobs here, and people are coming, and they need to work here, they need to live here, and they have children of going to school in San Francisco, they're going to have to pay for. They think they're going to have to pay for private schools, so they move to areas with a better public school system.
They bid it up for the school.
And that's why they're here.
So I have to ask you one other question, or point something out. So I was driving this morning, and I heard on the radio this ad from, Mortgage Company Anonymous, right? I know mortgages isn't your thing, right? So that's fine, but you're aware of what's going on in the market. And this ad is basically saying, act quickly, the Fed's about to raise rates.
Right.
Go in and refinance. Dry out your cash. 4 times in the advertisement.
Right.
They're saying, dry out cash. Take tens and tens of thousands of dollars out. So I'm listening to that and reading a stat that we actually produced in our weekly market commentary back in April, which said that in the last quarter of 2014, 7 million residential mortgages, making up 13% of the residential mortgage market, was underwater still. And that they define that as a loan that is 25% higher than the estimated property value.
That's a lot.
Right? Compared to early 2012, where it was 24% of the market.
Yeah.
What's going to stop these ads and these mortgage bankers from continuing to promote it? And this is just going to repeat itself. I mean, do you not see that happening?
I know. It's so funny because we've been hearing about mortgage rates going up for the last 3 years. and they've barely moved. They're still historically low.
Yes.
And I heard that same ad this morning, and it said, and what it said was, once they start, they're not going to stop, right? That's exactly the ad. Yeah, and I think it's a bit of a scare tactic.
So read my blog today about when we're going to get into it about prognosticating, because nobody knows what they're going to do, when they're going to do it, or how much they're going to do it. We're going to talk a little bit more about it. Well, and we talked earlier about millennials and first-time home buyers, right? What are you seeing is the challenge for those folks?
Well, so the first-time home buyer is generally going to get into the market at a house that's $400,000 to $500,000. It's either a condo, low-price single-family home. And what's happening now is that investors are going out there and purchasing those homes. So the first-time home buyer is competing against an investor, and the investor is not even looking at the house. They're just coming out and buying it because they want the investment. And so it's hard. It's really hard on first-time buyers. The affordability index, I don't know what the exact number is, but it's lower here than it is anywhere else.
Right.
Yeah.
Okay. And then going forward, where's the equilibrium gonna come from?
Going forward, well, it's either mortgage rates are gonna go up, okay? We need to build more homes, right?
Right.
But in Marin County, over 50% of the land in Marin County is open space.
Set aside.
So, yeah, we're not growing. There's going to be some affordable housing projects that are going to start happening here pretty soon, but that's not going to make a dent. So, what I'm going to say to everybody out there right now, if you're a seller, the glass is full for you.
Right.
If you have a house with any issues, if it's on a bad street, if something's going on in the house, now's the time to sell it.
Okay.
If you're a buyer, get your ducks in a row. If you can get cash, get cash. Get that loan later on. But be prepared to go out there and work up. You might think that the house isn't worth what you're paying for it, but in a couple of years, it should be.
Yeah, hopefully.
So hopefully it will be.
All right, thanks. Well, and then talking about the Fed more, everyone is now prognosticating, and we have these people, a Wall Street Journal survey that came out of 60 economists, and what did they say about when they thought the interest rates would go up from the aspect of the Federal Reserve? And 65% of them said September. Now this is migrating east as you look at this slide, and people are now talking about December or even next year. In the end, no one really knows. It's important for us to continue to talk about China, one of the biggest economies, second biggest economy, en route to the largest economy in the world. And what's going on there now presently, Marilyn?
So as Bruce said, and we mentioned earlier in the last slide, the Chinese banking system and its economy, while we watch it quite carefully, certainly not totally transparent like most of the rest of the world. So
right.
What's interesting is that the amount of debt has creeped up quite a bit, and it's grown 11.5% to 52.3 trillion yuan, which is $8.4 trillion in U.S. dollars. But what's not so good is that the rate of non-performing loans or bad loans has crept up about 38% to 641.5 billion yuan, which is about, in our dollars, about 180 billion. So it's not a very good picture. The ministers of finance, we understand, have lowered the interest rate 25 basis points this last weekend, so their interest rate now is 5.1%.
That's something like the sixth time they have.
Yes.
Yeah.
And they are tinkering, if you will, on all ends of the banking spectrum to try to write this picture. And at the end of the most recent article, the banking proponents inside China feel like they have more opportunities than challenges. But as an outsider looking in, I would say that this is something we need to watch very carefully.
Well, and the interesting thing, again, is when we talk about China, of a controlled government system and process, right? They can just turn levers and spigots whenever they want and however they want, which could lead them to create a soft landing over there in actuality. But again, we never know what to trust with the numbers.
Exactly.
And so it's one of these wait and see kind of things. But it will impact the rest of the world. There's not going to be, there won't be any getting away from contagion as if the Chinese economy really goes down dramatically. We'll touch on it again as we talk about the future. Let's touch on oil today, Andy. How are we doing with
one of my favorite subjects is oil. So, a little over a year ago, oil was priced at $98 a barrel. You know, and then it dropped down at the beginning of the year to close to $40 a barrel, and it's about around $60 right now. There's plenty of oil. There's plenty of supply. I mean, we see OPEC is pulling it out of the ground. U.S. companies have figured out how to do it, but the price has now prohibited certain U.S. companies from continuing to work. I mean, there was a interview on Bloomberg the other day with T. Boone Pickens, and they asked him, "Why aren't you drilling?" He said, "I can drill. I ain't drilling again till it's $65 a barrel."
And we're getting
right around there, so he'll start drilling. But what's interesting about it is that it's not quite as simple as just supply and demand. And we were talking about this the other day in a conversation. I mean, because it doesn't just translate, the price of oil, the decline of price doesn't translate to the pump. It doesn't translate to our airline tickets directly, right? Because it has to do with the ability to transport that oil or to refine that oil. When one of the Conoco stations or Union 76 refineries here in Richmond, when Station A goes down, all of a sudden prices are going up in the Bay Area for gasoline, regardless of the fact that we're pumping more oil out of the ground.
Yeah.
And we can. I mean,
we haven't approved a new refinery in the United States in 30 years.
In a long time. I mean, the general consensus by analysts is that $70 a barrel is about the price it should be at in today's world.
Yeah, should be.
Should be.
Right. Well, so the Saudis have decided they're not cutting back. So it's a game, right? We have all of the shale producers in North America on this game against the Saudis, against the Brazilians and Venezuelans and what have you. So this game is being played out. The Russians as well. And a lot of them have decided we're just going to keep pumping. I think we have a storage problem in the United States now.
They're sitting on rail cars and trucks.
Right.
In the Midwest.
They don't know where to put the oil anymore.
We need to annex another.
So where is this going to go with oil? Part of the problem is I filled up yesterday, and here in California, there's so much in taxes and additives and what have you that go into it that we didn't see much of a benefit here from all of that.
3 or 4 months.
Yeah.
Yeah.
I was in Kansas a few weeks ago filling up my pickup truck there, and it was $2.09 a gallon.
Really? Wow. Out here. All right, as we keep moving forward, let's talk about the future and what we're seeing out there as we go forward. It's interesting as we look at the estimates that people have on the GDP growth around the world and how they're changing. They're moving targets. And some of these numbers that you look at here in these 2 columns about what the estimates were in December and then what they are in February, speak to that. And we see some of these that aren't such big changes and others that are. I mean, as things start to happen, we see that in the UK, the expectations are being drawn down and the entire Euro region drawn down. Japan, others staying the same as we go down this list. Russia, expectations being drawn down. And this just speaks to the whole thing of being able to guess at what's going to happen in our economies. And we're going to tell you what we think, but in the end, no one really knows. So it's always with that caveat. The Wall Street Journal Economic Forecasting Survey said that a negative global event is the biggest threat to the U.S. economic growth. Well, that's nothing new. We could put this slide up there every quarter. I mean, it is true, any kind of asymmetrical event, heaven forbid that happens around the world when it comes to especially terrorism, could severely impact what's going on in the economy. So we have to watch out for that. Greece. We've been talking about Greece for a while now again. Even a few years ago when they had a settlement and a resolution with Greece, we talked to the fact that we just didn't think that was the end. It was the good old can kicking down the road of what's going on in Greece. And voila, here we are again. In February, you're looking at a comment that I posted on LinkedIn that I just didn't think that Greece was going away. And here we are. They're in the midst this week, as we speak, of negotiating what's going to happen in Greece. The new Prime Minister of Greece seems to want to play hardball. We'll see how long he can really keep his vest up like that, because the European Union has said they will not give $1 more of the bailout until Greece agrees to their terms. We'll see what's going to happen there. Now, they're telling all of us not to worry, that they have it contained. Now, when this was all going on a few years ago, the markets were in a panic. Now they're telling us, don't worry, it's all contained. We need to be on guard. I don't think that we can just trust that they have it all contained and there won't be any contagion of it. We know of a few investment companies here in the US that invested heavily in Greek bonds in the last few years who are now negotiating directly with the Greek government about how that's going to be handled. I mean, they are going to take a significant haircut, if not a complete default. So we're watching Greece. Of course, we're watching China, Marilyn, and we just can't underemphasize what's going on there and how it could impact us.
Sure. Let's go to the consumer now. And what's interesting, there was a report in a JP Morgan quarterly report. And what's interesting is that in 2011, when the GDP was 9.3%, 5.2% of the GDP was made up of what we call consumer spending, much like our economy, where we make up supposedly 70% of it. If you just look back at 2014, where we just said that the GDP was 7.4%, that consumer demand or consumer spending has fallen from 5.2 to 3.8. So just about 50% of the GDP is consumer spending. What is going to be telling is what happens over the next several months with the banking issues that we talked about, the Ministry of Finance tinkering with the economy, whether or not the consumer spending or demand will continue to be at about 50% of GDP, because it's going to fall to 6.3 based upon the estimates, or whether or not something else moves inside the economy and perhaps the consumer demand starts to become a greater part of the GDP. It's a big question mark in our mind.
What kind of concern do we need to have? You know, the standard of living for millions of people in China has changed in the last 10 years.
Right.
The growing middle class of Japan, their expectations are completely different than what they were 20 years ago. How concerned do we need to be about social unrest in China happening and then a government claim, right? I mean, these are...
Yeah, sort of like Tiananmen Square, you know, that's 15 years ago. So, yes, I think we need to be concerned about it. The economy, in terms of the workforce, has grown and translated quite nicely from mainly agriculture, as most of us know, to industrial. But what's interesting is that they're going through what the U.S. has gone through quicker in terms of evolution. According to a report, there's 300 million people now that work in the services industry in China,
right.
And they're expecting, which is about 40% of their workforce, which is a huge shift from agricultural to manufacturing, industrial, now to services. And these are the people that are the growing middle class, and will want more goods and services like other developed nations.
Great. Okay. Thank you. And then there we get to what's going on about growth here, anticipated rate hikes. We've talked about it over and over again. Estimates are being drawn down and drawn down. Stock values, as we continue to look at what's going on in the market, we're seeing, you know, price earnings ratios, PEs, that are getting quite high. And And earnings reports, as you know, we're at the end of the current earnings season. Earnings came in just okay, but it is affecting that price earnings ratio, which is, again, it's getting to be at record levels.
One quick note that was just about the Fed and the rates. So we had some great news last week in that General Motors announced, right?
Oh, yeah.
General Motors announced they were going to borrow and invest $7 billion for factory makeovers here in the United States to take advantage of this. So this is good for our economy.
Absolutely. So we've been talking about that there's, you know, I think the number is something like $2.5 trillion sitting idle that corporations just aren't spending. That is great news. You know, if we can get a trend going like that, it would be even better.
Jobs, infrastructure, efficiency.
Here's some barometers here, Marilyn. I know you've been watching some of these as our research department puts these great little barometers out on a regular basis.
Right. The Global Business Barometer does a survey and it asks 1,500 senior executives who make key decisions, as Andy just said, for key investments. And it looks like this is an improving barometer, and as Andy mentioned, you know, companies like GM are making big capital improvements and using some of that excess cash that's been sitting on their balance sheet. So that's good news for markets, and it's certainly good news for those companies making those investments.
Right. All right, and let's talk about the expectations. So what are people saying is going to happen to GDP growth in the U.S. coming up? And in my blog post that's out today, right? I think Sally came out today. Mm-hmm. This chart is in that blog post, and I speak to prognosticating, and I've mentioned it here a few times, and those of you that know us know that we don't believe in it. But I thought it was interesting in looking at this chart of the wide range of estimates that are given by corporate executives around the world about what do they call consensus estimates. And then when we beat estimates, how excited everyone gets that we beat lowered estimates. And that lower line up here is actually the Atlanta Regional Fed, and they're estimating going forward. And I find it really interesting here of how they kept making adjustments down and down and down in the first quarter. And sometimes they came out with their adjusted expectations after the month already occurred. So lowered estimates are the trend. Now, where do we have some optimism, Marilyn? Let's not be all half empty.
Let's not be pessimistic. Right. What's interesting, if you look at these two charts, one is from the end of 2014, which has been revised, and then an updated for Q1. It looks like agriculture was up for the year. However, in the last 3 months has taken a kind of a nosedive. So it's somewhat unclear as to why, with the exception if we're talking about California and our drought. Obviously, agriculture is going to take a big hit this year. The second area that is of notable change would be manufacturing, where it was negative Q4 of last year, and it has taken a fairly big bounce. Yeah. Back up to, you know, over 20%.
That's worldwide. It's not just
it's worldwide. Sorry. And over the other industries, consumer goods, I think because the economies generally are doing better, I think consumer goods certainly are on an uptick.
Okay. One of the things we were asked, by the way, before the webinar was, when is this bubble going to burst? This is also addressed in my blog. Today, we're being asked this a lot as we're doing a lot of annual reviews this time of year, and we can't tell you when the bubble is going to burst. A lot of things are putting a great deal of pressure on the markets and the economy, which is making us concerned. One of those are the PE ratios that we saw a couple of slides ago, and that they are at record levels. Please read my blog post to answer that question in greater detail about when is this bubble going to burst, right, assuming it is a bubble. And earnings is one of the things that we need to keep an eye on. And there's some good news and some not so good news when you look at this thing that's put out by our research department at LPL. And, you know, look, 44% of companies beat estimates so far out of 400, how many? I can't see the number. close to all of the S&P 500, right? We have a couple weeks to go, I think, till we'll get the rest. Two things, when you look at that, those are based on lowered estimates, and then that means that 56% of those did not beat estimates. We also see in that left gauge there hanging out of the side that top line revenue growth just wasn't there in the first quarter. So it's a good news, bad news situation, right? We're seeing earnings per share go up. We're beating on bottom line estimates, which is better than not. Don't get me wrong. We would still like to see top line revenue growth, which is a very important metric to.
I love this graphic.
A little bit better.
Yeah.
I love this graphic.
Yeah,
It's an old-time radio. It's great.
Yeah.
It's great.
All right, but as I said, we are long-term positive here. We believe in this country. We believe in the system in the country, and we believe in the people who live here in the country will get us to have a strong, long-term, growing economy.
We say the only long-term realism is optimism, or why bother? So we spent a lot of time here discussing the outlook for world economies, the markets, and monitor economic and market developments closely. We try not to let the noise, the day-to-day noise, and those events determine our actions. We don't take action haphazardly, and until our process indicates that we should do something. We like to say around here that it's about discipline and process, not attitude and opinions about things. So we have confidence in our process, and it's the reason that we sleep well at night, most definitely. But I would be remiss if I didn't thank Sally and Emily, just want to take a second here, for organizing and facilitating this webinar and event. And also just to mention, Bruce has known him for a long time, but he has a relentless pursuit of relevant and timely information to bring to these events, which we value, and Marilyn's research, and of course, Mark, your participation and insights on real estate today. Everyone around this table in a collaborative way makes it so much easier for all of us to do what we do, which is to look out for you, our clients. That is our job. I do have a current event update for YBFP for you quickly to share with you. Then, as you know, we were founded on the principle and have always been an independent, conflict-free, comprehensive advisory firm. And as part of our continuing evolution, we've begun the process of registering with the regulatory authorities to become our own RIA, which is a registered investment advisor. So what does this mean? This means that it's going to give us greater flexibility for you, more timely communication, even greater transparency about our models and investment strategies, and ultimately, I would say, a more robust solution set that we can bring to you, our valued clients. We expect this transition to begin in or around the end of spring or early summer. Those of you who are advisory clients with the SAM Strategic Asset Management or OMP accounts should expect a one-page form to facilitate the refiling and registrations of your accounts. This is a minor administrative task that we would be able to do by snail mail or electronically, but we're really hoping that it'll serve as a catalyst, as Sally said earlier, to have the annual reviews with those of you who we haven't met with lately.
I think we're going to hold a couple of open house events here at the office as well.
Great idea. Yeah. Excellent, because we want to see you, and we want to be seen too. So we're excited about this change and the possibilities that it's going to be able to provide for you. So we can assure you that no matter what the remainder of 2015 and the future holds, we're here to help you. Our firm is designed, built, and operates to help you reach your financial goals and make an even greater impact on the people and causes you care about. So on behalf of the team here, I just want to say thanks for joining us, and back to Sally.
Thank you, Andy, and thank you to the team. Thank you all who joined. We look forward to hearing from you all soon. Take care.